Okay, greetings everyone. Welcome to another of RIJ's webinars in a kind of occasional series. When something important comes up, we try to do a webinar on it. And we have an important occasion right now with Wade Pfau's new book. My guest needs no introduction, as they say, but I'll give him a quick introduction anyway. Wade Pfau is, besides the author of 4 recent books on retirement planning, is the professor of retirement income at the American College. He's the co-director, I think, of the program there for the RICP, Retirement Income Certified Professional. He's a director of retirement research at McLean Asset Management, and he is has a business and a blog and other things at Retirement Researcher. Is that right? Retirementresearcher.com. Yes. So I don't know how he wears that many hats, but he does, and he's been doing it for a long time. And he's one of the you can count he's one of the top 5 retirement income experts in the United States, and maybe even closer to the top than that. So we're lucky to have him here today for an hour, and we're lucky to be talking about this new book. And let me just give you a couple of ground rules. Questions can be written in the Q&A section that Zoom provides. And yes, there will be a recording that's sent to everybody who's registered afterwards, within at least a day or two. So let's get started. We're talking, of course, about Wade's new book, Retirement Planning Guidebook. It's a 462-page book, and it is extremely comprehensive. Wade, let me just let you explain what you were trying to do with this book that you hadn't done in previous books.
Sure. Yeah. Thank you, Kerry, and thanks for the nice introduction. And indeed, this is really the book I was always trying to write. It ended up being my 4th book, but to some extent, I started writing it about 9 years ago. And the first book I ended up writing was on reverse mortgages. And that was just a matter where I was trying to write a housing wealth chapter for this broader book about retirement income. And at some point that got so long that it became a book in and of itself. So it was really in the process of writing this book. I ended up writing other books, but I was always trying to write really like a textbook or a more comprehensive book looking at all the different aspects of building a retirement income plan. And Amazon says the Kindle version is like 700 pages long because I really packed a lot of text onto each page. But that's really what I'm trying to do here is walk through the steps of every aspect of retirement planning. And that starts, and I think we'll spend a lot of time today talking about the retirement income style awareness as a step 1 of just thinking about how do you want to approach building your retirement income strategy? Then talking about the different retirement risks, looking at different tools that match the different styles between systematic spending strategies from investment portfolios and how different types of annuities work. And then looking at Social Security claiming, healthcare and Medicare planning, long-term care planning, housing decisions, tax planning for retirement and efficient distribution strategies, legacy and incapacity planning. And then another area where I really had to do a lot of background reading was with the non-financial aspects of retirement, which are really as important as any of the financial considerations. But how do you find purpose and passion and a replacement for work if that's like not every retirement has to stop work necessarily, but how do you find something to do in retirement? And then putting it all together at the end as a kind of action plan of all the steps at different phases of the retirement planning process to organize everything into a clear, systematic way to make sure you haven't missed any of the important aspects for retirement.
Mm-hmm. Yeah, everything is here. It's a truly comprehensive book. It would take a pretty ambitious amateur to actually follow through with everything. I think most people are probably going to still want an advisor, but an individual should really read this book in order to prepare themselves for the advisor experience and know what to ask. So it's valuable in that sense too. So let's just start. Wade, do you want us to walk through these slides at your own pace?
Sure.
Just let me know when you want to change.
Okay. Well, this slide is walking through, the book has 13 chapters, and that's really 12 different steps. And that's what we were just discussing with going through the contents of the book. Just step number 4 in this slide is combining, there's a chapter on systematic withdrawal strategies and time segmentation strategies. And then there's another chapter on risk pooling and using annuities for retirement income. And those are condensed into item 4. But otherwise, this walks through the steps. I think the other one we didn't mention was quantifying financial goals for retirement. And I do that in terms of the 4 L's: longevity for core retirement expenses, lifestyle for the discretionary, legacy goals, and then liquidity, which opens up a whole nother issue of like what liquidity means exactly, but thinking about it more as assets not earmarked for other purposes that can count as reserves for the spending shocks that you anticipate and want to plan for. So that would be step number 3. And then otherwise, it's the things we covered on the previous slide, walking through these different aspects of the retirement plan.
Mm-hmm. Yeah, and as one example of a spending shock, I had one just earlier this year. I needed a new septic system. We live in the country, so that hadn't been in my retirement plan.
Yeah, you can have your budgeted plan perfectly done, but still there's all these surprises that come along that you need something. It's not just about an emergency fund, but really, and long-term care is a big one. If you're thinking to self-fund long-term care, you may not be comfortable retiring until you can handle whatever scenario you think is most appropriate, like a 4-year nursing home type situation, whatever you want to have in your plan to manage your concerns for that risk. And then just having additional assets to cover that. Mm-hmm. But yeah, going to this slide. So chapter 1 starts with something that's really new in the literature. And that's this idea of retirement income styles. I mean, we've known for a long time there are different retirement strategies. For a long time, it's been based on a systematic withdrawal approach, time segmentation, which was kind of a hybrid between systematic withdrawals, and then essential versus discretionary, which is like building a lifetime income floor of protected lifetime income and then having a more discretionary investment portfolio on top of that. But we haven't really had a way to help people determine which strategy was right for them. How do they pick a strategy? We've had risk tolerance questionnaires, but risk tolerance questionnaires really presuppose everyone is just a total return investor. And I've seen so many examples of that frustrate me, of like different financial service companies marketing. They'll explain there's risk in retirement. You have longevity risk, you have sequence of returns risk, but then it always gets right back to let's build an investment strategy to manage that, which is appropriate for some people. But with this retirement income styles and what we've been able to do in terms of surveying about 1,500 participants at Retirement Researcher, maybe only about a third of the population really fits that sort of systematic withdrawal total return investing strategy. And for other people, they might look for something different. But the idea of what we were doing here, and this is something research I did with Alex Margia, we read through all the literature, everything like consumer-facing retirement planning books and so forth, and tried to get a sense of what are people talking about as different preferences or different factors that can explain decisions about retirement. And to some extent, I've been thinking about this for a long time in terms of, I talked about the probability-based school of thought and the safety-first school of thought. And those names live on as one of the factors. But we made a list of factors, and then we did, it's called an exploratory factor analysis to try to understand which factors explain distinct preferences. And what we found was the two, what you see as primary factors on this slide, overwhelmingly are the most important in terms of explaining how someone thinks about retirement. And so probability-based versus safety-first was sort of reborn in this context as a probability-based person is comfortable relying on market growth. And that's really the basis of a systematic withdrawal total return strategy. Like if we think back to the 4% rule of thumb, which is the classic probability-based approach, it says to hold 50 to 75% stocks throughout retirement. And you should be fine because you should get, the stock market should outperform the bond market, and you should be able to spend more than a bond yield curve could otherwise support. And so fund your retirement that way. Well, if you're comfortable relying on that market growth, you're probability-based. But in contrast to that, safety first, there's more a sense of you'd like to have some sort of contractual protection to support your retirement income. you're not necessarily fully comfortable relying on the stock market to generate outsized returns to fund a higher lifestyle than bonds alone. And that could be individual bonds. And that's where time segmentation starts to get more of a sense in this context of being safety first, because it has fixed income contractual protections for the short term. But also there, of course, annuities, having a contractually protected risk pooled to support additional mortality credits, protected lifetime income floor. So that probability-based versus safety first, it's relying on market growth versus wanting a contractual protection. And then the other factor that came out of the exploratory factor analysis is very important was this idea of optionality versus commitment. Optionality is a sense of, I want to keep my options open as much as possible. I don't really want to commit to any type of strategy at all. I just want to have the flexibility to make changes and to adapt to new situations and take advantage of new opportunities. And commitment, on the other hand, is there's more willingness to commit to a strategy, that if there's a strategy that you know can work for you, you can take that off your to-do list. Okay, I'll commit to doing this strategy. I don't have to be as worried about it. I don't have to think about it on an ongoing basis. I know it's going to work for my situation, and so I'm fine. Let's just get this off the table and not have to be as worried about it. So how do you feel about optionality versus commitment? And then we did find 4 other secondary factors that help to explain the story, because what the really interesting thing that came out of this was when we started to lay these out, how people, their preferences fit into these different factors, it explains all the existing retirement income strategies we have. Mm-hmm. And so to help support that story, just time-based versus perpetuity is, do I want a floor that's like time segmented, or would I rather have a lifetime income floor? Mm-hmm. Accumulation versus distribution is, the accumulation mindset is just the pre-retirement investing world, modern portfolio theory, maximizing risk-adjusted returns. And that's my focus, even in retirement. Whereas distribution as a mindset is, no, I'm going to focus more on predictable income. My focus is no longer just maximizing the risk-adjusted return on my portfolio. I put more emphasis on predictable income. Front-loading versus back-loading is just the idea of, when do you want to spend? If you have a preference for front-loading, there's more a sense you want to spend today while you know you're healthy, you know you're alive. You're okay making cuts later in retirement if you happen to still be alive at that point, but you really want to make sure you get the most out of those early retirement years. And if you have more of a backloading preference, you have longevity risk aversion. You're worried about outliving your assets. You're willing to have a more stable lifestyle today, or less, not as aggressive of lifestyle today, so that you can better ensure that if you do live to be 95 or 100, you still have resources and assets available. You're willing to backload some of that spending to later in retirement. Mm-hmm. And then true versus technical liquidity. Well, technical liquidity is how we usually think about liquidity, just a liquid brokerage account. You have access to the underlying funds. But in retirement, and this is part of the distribution mindset, if I had $1 million in a brokerage account and I want to spend $40,000 a year, and I believe in the 4% rule, even though my assets are technically liquid, I don't have any true liquidity, because the entire $1 million is earmarked to meet my future lifestyle spending goal. And the idea of true liquidity is, this is an asset that's discretionary because it's not earmarked for other purposes. It's available for whatever I want to use it on. And that's, if I think that way, then there can be more a sense of something like a SPIA that's technically not liquid, could create more true liquidity for the financial plan by using risk pooling to meet the spending goal with less assets for somebody, especially who has that backloading preference, who's worried about outliving their assets, where they might live a long time or get poor market returns, and just has to devote a lot more resource to meet that lifetime spending goal, and therefore has less true liquidity. So these are the factors we came up with in terms of, they actually can be explained and described as distinct factors that people have that we now want to translate into a strategy.
Now, Wade, you have created a questionnaire for making assessments, right? For that an advisor or an individual could use. And just could you briefly, we'll cover that at the end, I think, but you said that's available on from Retirement Researcher, did you say?
Yeah. So the idea was to make a questionnaire to ask questions that get at each of these factors, and then and others that ended up not being important. and to see what really then teased out as being an important factor. And so we did that. The initial study was with about 1,500 participants at Retirement Researcher. And we really found that this was quite interesting. So we have been trying to build it out. Now, if anyone would like to take the RISA right now, on page 15 of my new guidebook, there's a link to do that. And if you want a little life hack, if you go to Amazon and click on the look inside and then go to the Kindle edition, you can find that link in the look inside part there. And we're going to, in October, offer this to an advisor, for advisors on October 25th and 26th. We'll have a 2-day advisor challenge where we'll go into more detail about the research, provide an opportunity to take the RISA and get your results, and then discuss how you might implement this or use this within a firm. So that if you go to risaprofile.com, there'll be a pop-up on the screen if you'd like to sign up for that 2-day workshop, October 25th and 26th.
Okay. Are we ready for the next slide?
Right. And so this was the really interesting part of how well these things turn out, where if you take somebody's scoring on these different factors, they actually translate into retirement strategies. And so the 4 strategies you see here, total return, that's what we're calling systematic withdrawals. It's a total return investment approach, taking some sort of decision rule about how you spend from your portfolio, but you do that relying on market growth, the stock market, a multi-asset class, well-diversified investment portfolio. The other time segmentation is time segmentation. Bucketing, it's the idea I use fixed income for shorter term expenses, stocks for longer term expenses. And then the essential versus discretionary, we split into 2 different strategies. Income protection is more the classic kind of SPIA or DIA type world of having an annuitized contract. Fixed index annuities might also play a role there, but supporting the most downside guarantee and not necessarily having as much upside potential within the annuity. And then risk wrap is the whole deferred annuity world, where you can have a variable annuity, a RILA, something with more upside potential along with more downside risk for the contract value. But because you have more confidence in market growth, but wanting to put some sort of guardrail around that so that even if markets don't do well, you still have that protected lifetime income. I think then the next slide will explain better how we go from the factors to these strategies. Or not quite yet. I've actually already explained this one, so we can, there we go. Yeah, so this is then how this all plays out in practice. This is the retirement income style awareness RISA matrix. And so we look at somebody's scoring left to right with its safety first versus probability based. And then up and down is optionality versus commitment. And then I added in how the secondary factors fit into this as well as supporting that. But what we can see, like we can walk through this and see how well it explains the actual strategies we have. And there is the natural correlation. People who are more probability based, so they're more comfortable with market growth, they do tend to be more optionality oriented as well. And so in the upper right hand quadrant, if somebody's comfortable with market growth, wants to keep options open, from the secondary factors, they don't have a preference for perpetual income flooring. They have an accumulation mindset. They're not as worried about the distribution, predictable income. They're front loading their expenses, and then they're more comfortable with the concept of just technical liquidity for assets. They don't distinguish true liquidity. That pretty much explains the total return, the systematic withdrawal type strategy. So people who have those preferences are reasonably well served by a total return investing strategy. That does tend to be the default in the consumer media. It is appropriate, we think, maybe for around 1/3 of the population, but that's total returns. And then you see that diagonal arrow because, again, the more natural correlation, then going down to the lower left-hand quadrant, this is somebody who's safety first, so they like contractual protections, or they have a preference for contractual protections. They're commitment oriented, so they're willing to commit to a strategy as well. They have the true liquidity mindset, wanting to have, it's not liquid unless it's something not earmarked for some other goal, like meeting my budget in the future or meeting a legacy goal. They've got a distribution mindset. They're focused more on predictable income over risk-adjusted returns. They like perpetual flooring, and they have a backloading preference. They want to make sure they've got longevity risk aversion. They're worried about outliving their assets. Well, all that, we call that income protection. That's the world of income annuities, SPIAs, VIAs, the most guaranteed downside protection for that flooring. And then you can have the investments on top of that for the discretionary, but they'd like to have secure, protected, sustainable lifetime income. And then that looks to be about a third of the population. And then what I thought was the most fascinating aspect of it was the other two strategies, time segmentation and risk wrap, are really behavioral strategies. They're not really designed to be somehow like a better investing approach, but to try to accommodate preferences that aren't internally consistent. So if we look at the upper left-hand corner with time segmentation, these are people who want contractual protections, but they also want optionality. And it's hard to have options if you're committing to a contract, but time segmentation evolved as a way to handle that type of preference. So that's where your contractual protections are. You have a front-end fixed income bond ladder or other kind of bond fixed income approach to cover the short-term expenses. And then you have your diversified aggressive growth portfolio to cover longer-term expenses. And the behavioral quirk there that people rely on is the idea of time diversification, that it's the stock. We were talking about Jeremy Siegel before the webinar started. Like, if you believe in stocks for the long run, then time segmentation is something that might resonate with you as a strategy. And we think that might be about a sixth of the population. And then in the lower right-hand corner, that's another behavioral strategy that's just developed since the 1990s. So these are individuals who are comfortable relying on market growth, but they also have a preference for committing to a strategy. They have the technical liquidity thinking, which is how, like a deferred annuity, we say it's liquid, but it's really just like an investment portfolio meeting a spending goal. Even though it's liquid, if you've earmarked that asset for future spending, you don't have true liquidity with it necessarily. But the technical liquidity mindset, the backloading, you are worried about it. Like you're comfortable with market growth, but you're also worried about outliving your assets. So that's where the deferred annuities with guaranteed lifetime withdrawal benefits developed as a behavioral solution to help accommodate these preferences, getting a level of downside protection along with upside potential and liquidity for the underlying contract value of the account as an approach to meet that sort of preference or that sort of style. And so we call that risk wrap as just a way to identify that general style. And so somebody can take the RISA questionnaire and the report will show them where they fit on here. And I think that can be an important starting point for the conversation of how would you like to go about building a retirement income strategy? And that's something we don't have currently. All we have is a risk tolerance questionnaire, which again, I've seen so many people talk about risk tolerance questionnaires as a first step for a retirement plan, but it's always just presupposing everyone's total returns. It doesn't give you a role for an annuity or for a time segmented strategy or anything else. So as a first step, understand what style resonates with you, and then go about figuring out how you build a strategy around that. And that's what this RISA matrix is designed to do.
Now, Wade, it seems like this is kind of an evergreen strategy, that you think of it as something that doesn't have to be affected by the current market conditions, because it seems like when people meet with advisors, they've heard things in the news and they're terrifically worried about what to do now and what dangers lurk ahead. But you intend this to be pretty much evergreen, right? Not to be, or would you suggest that maybe it has to be trimmed? Take this as an evergreen strategy and trim it according to current conditions, or just ignore current conditions?
Well, that's a concern about risk tolerance questionnaires, is that people's risk tolerance adjusts to what the market's been doing. So this is still new enough. We don't have any very long-term analysis about it, but we benefited from what academics call a natural experiment when we were doing the questionnaire with the retirement researcher community. The first iteration of it was in March 2020, which was right when it seemed like the sky was falling. The S&P 500 was down however many percent at that point. Things were looking pretty awful. And then we did a retest with the same population in September 2020, when things were starting to look up again and were looking much better by that point. And we found a high degree of consistency that between March and September 2020, people were not necessarily changing their styles at all, that it wasn't something being driven by short-term market performance. It wasn't that in March 2020, everyone shifted to income protection, and then by September, they jumped to total return. There did seem to be strong consistency. And that's all we can say at this point, to at least point to the idea that it looks like these strategies have some stability to them. It's not that somebody's fluctuating around based on just the most recent, whatever it is they've been thinking about.
Now, another thought is that sometimes we're advisors are come to the conclusion that their clients are basically irrational, and it requires advice to keep them on course during market upheavals, and that there seems to be an assumption on your part that people are rational they just have different personalities and different ways of looking at the future, but that they're not irrational.
Yeah, definitely with my economics background, though, there's been the whole behavioral economics revolution, but there's certainly a starting point of assume people are rational and then just try to understand why that's the case. And in terms of understanding that point, it may be people are getting pigeonholed into the wrong style. So I may be put into a total return strategy, but if that's not my style, I'm never comfortable with it. And my lack of comfort with it could really come to the forefront during a market crash. And it may have been the case that maybe I should have been in an income protection strategy the whole time. And that would have allowed me to get over, or to get through that. I know in the long run, the stock market should go up, but when I'm retired, I don't necessarily benefit from the long run. And I'm very concerned about what's happening. I maybe shouldn't have been in that total return strategy. And that's where the risk tolerance questionnaires can't pick that up. There's different retirement concerns people have. Some people are concerned about longevity, their core spending, and not outliving their core spending abilities. Some people are more concerned about lifestyle, which is how can I maximize my overall lifestyle in retirement, and in the short run, at least, more of a front-loaded preference there. Some people are concerned about the liquidity and having reserves, and maybe uncomfortable spending because they think they have to save all their money for long-term care. And a risk tolerance questionnaire we found can help to explain lifestyle concerns, but not the longevity concerns or the liquidity concerns. So if you've got somebody who has these longevity, particularly in this example, longevity concerns, being placed into a total return strategy that doesn't address those because it was just determined by a risk tolerance questionnaire, and that person may not be in the right strategy, and they're not being served properly by that strategy. And when the time comes, they panic, and they just can't handle the strategy they've been given. It doesn't resonate with them as meeting their style or personality.
And that's a moment, I would think, when an advisor might well lose a client.
Well, potentially, right. If the advisor, so we start from the point that any of these four strategies are viable and reasonable approaches to take. There's not one superior solution. I do know some advisors start from the base that there's one superior solution. I see that a lot with like a total return, assets under management, investment management type advisors. And even I've seen that too with time segmentation, folks kind of acting like time segmentation is a superior approach for everybody. But at the end of the day, I think any of these four strategies are viable. And so the advisor who does only think in terms of one and tries to put everyone into that one strategy, right? I think they may be, that could be a cause for losing a client if they're putting somebody into a strategy that really isn't right for that client. It's just they think their strategy is right for everyone. And the reality is it's not going to be right for everyone.
Well, let's move along.
Well, so these are then just pointing out like, well, what kind of tools fit into these different styles? And the investment piece maybe is not quite as interesting. It's pretty basic. If your systematic withdrawals, total returns, you're just focused on a multi-asset class investment portfolio in the upper right-hand quadrant. If you're in the upper left-hand quadrant, you're no longer thinking of asset allocation of 60-40 total return portfolio, but it's like, well, do I take 40%, put that into fixed income because that will cover 8 years of expenses, and then my 60% stocks are meant to cover years 9 and later. So you treat fixed income differently. You might have the same overall asset allocation, but you're treating the assets differently. You're earmarking them to different time segments. And then in the bottom half, you're first building a protected lifetime income floor with reliable income assets. And the investment portfolio only comes into play for the more discretionary types of assets that layer on top of that.
Mm-hmm. Wade, do you think a period certain annuity would could substitute for a bond ladder? Probably they're both tied to the interest rate environment. So would one work as well as another?
Yeah, the period certain annuity also can give the exclusion ratio tax treatment to be potentially a little bit better too. But right, when it comes time to actually build that bond ladder, I am using that as a more generic term of you'd want to look at all the different fixed income alternatives and see which has the best pricing at that particular time. And certainly a period certain annuity is a viable candidate to build the bond ladder with. Bond ladder is just meant more generically here of
right. Well, I guess you'd have to imagine how much overhead there is on a on the annuity. I think I heard you say once that there's about a 15% that buying a product from a life insurance company has about a 15% margin from actuarial fairness.
That might be more like a permanent life insurance type number. Sometimes the SPIAs and the DIAs, that you can look at their money's worth ratios of just if it was fairly priced, what would the payout rate be, and compare that to what it actually is. And I've looked at that sort of thing especially in my Safety First retirement planning book. And SPIAs and DIAs weren't in that. They could be much lower. In some cases, if you're somebody who's quite longevity risk averse, compared to the subjective mortality you have in mind, the SPIA or DIA could look cheaper than trying to self-fund that. So
sure.
But I think especially period certain annuities would not have that high of a overhead charge baked into them.
Yeah. Okay, let's move along.
And then here's how to think about annuities. And I didn't write out period certain annuities in there because it was too much text. But like if you're in the top half of the RISA matrix, you're probably not going to be using a lot of annuities generally, or at least not for protected lifetime income. If you are in the time segmentation in the upper left-hand quadrant, like you just said, a period certain annuity could fit there. Or you could think of more like annuity as a fixed income alternative, whether that's a multi-year guaranteed annuity or a fixed index annuity with the principal protection, but some upside linked to an market index. Those could be potential assets there. If you are in the total return quadrant in the upper right-hand side, again, you're not going to be looking to using an annuity for lifetime income, but you might look at the tax deferral opportunities, whether it's a low-cost investment-only variable annuity, or now with the interest in like structured ETFs and RILAs as an alternative there as well, of something that will just cause some downside protection, giving up some upside potential, but it might have a nice fit in your overall like asset allocation approach. And then most of the action with annuities would be in the bottom half of the RISA matrix, where you are thinking in terms of protected lifetime income. So either annuitized contracts or deferred annuities with living benefits. And in that regard, the more safety first you are and the more commitment oriented you are, you're going to be more comfortable with actually annuitizing a contract. So a single premium immediate annuity, a deferred income annuity. And then as you shift from the left to the right in the bottom half of the matrix, fixed index annuities can play a role with the living benefits, especially there may be an opportunity for competitive payouts to SPIAs and DIAs and still having that contract value that's technically liquid and some upside potential. And then as you're moving further to the right, we're getting into like a RILA, the newest product on the market in terms of giving you more upside potential, but also no longer having principal protection, having to accept some downside risk. And then to the very right, a variable annuity that gives you more investment freedom to invest more aggressively, but still has that protected lifetime income through a guaranteed living withdrawal benefit would be most probability based. You're more comfortable with market growth. You believe you'll get the upside, but you just want to have some sort of guardrail. The guaranteed living withdrawal benefit is like a put option on the stock market. So you have downside protection for your spending from a market crash, but you still have that to some degree exposure to the market upside.
Mhm. Now, Wade, what do you think about RILAs? Their sales have been, I mean, not they're not great compared to, say, a mutual fund or ETFs, but within the annuity world, they're skyrocketing.
Mhm. Yeah, I've done some investigations of them, and at first I wasn't so sure about this idea of not having the principal protection there. But at the end of the day, it seemed like, especially like a 10% buffer, I was thinking seemed to be a pretty good sweet spot, where that would be one that eats up to 10% of the losses, and then you have risk beyond that.
Hmm.
But by accepting that, you get more upside potential. And it just seems with the way markets work, there's a lot more cases of that upside potential paying off than there's not so many circumstances where we have more than a 10% loss in a year. So it actually seemed pretty effective. And I mean, that's just doing some simulations about how they perform with Monte Carlo simulations. But yeah, I've definitely kept my mind open to RILAs as a potential tool for retirement strategies.
Yeah, it seems like a reasonable choice for people who can bear a certain amount of risk. It's basically a structured product. I think the advantage is that if you try to if you try to go to an investment bank and build a have a structured product built for you, it would be pretty expensive. But the insurance companies have been able to make RILAs a kind of a retail, an easy retail individual sale.
Mm-hmm. And I think this all plays out pretty well with how this RISA matrix can be approached. And we're working with Canex now to actually map the universe of annuities to this, so that if somebody is in one of these particular boxes, to be able to then suggest, here's 5 annuities that really fit well into that style in terms of the trade-offs of the annuity between its downside protected income, average income, and from a Monte Carlo. They run all those numbers. Mm-hmm. And then the surrender charge schedule, fees, and so forth, trying to put those elements together to get a sense of where does each annuity fit into this RISA matrix to help people then, right. Like if you're thinking about an annuity and then you start looking and you find out, oh, there's 3,000 different options.
Right.
There's analysis or paralysis. It's just, you don't know where to start. And hopefully by being able to give a short list of, here's 5 annuities that work well for where you are in your RISA matrix, I hope that can be a useful addition as well.
Mm-hmm. Well, the ratings help, but there is a little bit of a tug of war when you're assessing annuities between the highest ratings and the highest payouts. Mm-hmm. They're not they're in opposition sometimes. Are we ready to move on?
Mm-hmm. Yeah, and so then this is the RISA matrix, and this whole thing developed initially as just kind of a way to help understand where people were coming from as they entered retirement researcher. And so we also looked at this idea of how do people want to implement financial advice. And so this will be something that we explain in more detail too at that advisor challenge in October. And what we found is we kind of went through the same research process as with the retirement income style awareness. And we found these 2 driving factors are, we asked questions about like, how useful do you find an advisor? And it's not necessarily just, are they useful or not, but do they provide value beyond their fees? And of course, most advisors, we understand how advisors can provide a lot of value, but not everyone agrees with that. And it can be hard to convince somebody. If someone just doesn't perceive an advisor as adding value, then, I mean, what are you going to do? It's hard to explain them out of that kind of opinion. But we were able to rate, like, do you perceive an advisor as useful or not so useful? And then this other important factor we found was, like, what's your retirement income self-efficacy? Do you feel like you can do this retirement planning on your own? You feel comfortable about it? Are you willing to spend the time on it? You may feel comfortable, but if it's something it's not part of your life, you don't want to do it, you'd rather outsource it, you'd be more of a low self-efficacy. But how do you feel about doing your retirement planning? And then from that, we get the same sort of matrix where, to start, if you're in the upper right-hand quadrant, you see an advisor as useful, but you also, you have high self-efficacy, you're comfortable doing your retirement planning. So that would be more of a collaborator type relationship, where you might have a traditional like assets under management or full service advisory relationship. But these are the clients who or reading reading my book as well, or whatever the case may be, and may have more questions for you or want to be more of the process. Going to the lower right-hand quadrant, these are individuals who have the high self-efficacy and the low advisor usefulness. So they're not really going to generally want to work with an advisor. And in that regard, an advisor who may be using this with a prospect may think there's not as much, it's not worth putting as much effort into trying to build that relationship because it's unlikely that individual would ever agree to work full-time with an advisor. Now, as we built this out with Retirement Researcher and McLean Asset Management, because a lot of my readers are self-directed, we decided to build a Retirement Researcher Academy, which is a paid membership site. And so for people who are more self-directed, we offer them the Academy as an option where they can ask questions, they can watch the whole archive. We do monthly, I do these 3 or 4 hour workshops every month on some of these different topics from the book and so forth. And so they have that as a resource. Then if they're in the lower left-hand quadrant, these are people who don't see a lot of usefulness from an advisor, but also have low self-efficacy. So they're not as comfortable doing their own planning. They're probably not going to want to have a full-time advisory relationship, but they might want a one-time plan, or they might want some interaction when there's a decision they need to make. Like even if it's something like a Social Security claiming analysis, they might pay for a one-time type decision or even a one-time financial plan, but they don't want an ongoing assets under management relationship. Mm-hmm. And so to help meet that preference, we did add more one-time planning services at McLean and through the Retirement Researcher as well. And then if you're in the upper left-hand corner, well, this is probably the more classic assets under management style client who perceives the advisor as useful and so is willing to pay for that service and also has low retirement income self-efficacy. So they're going to delegate having the advisor handle these financial concerns. Mm-hmm. And that's the traditional type full-time advisory relationship. So when someone takes the RISA, mm-hmm. the advisor or the individual, if you want them to see this aspect of the report, they'll know not just their retirement income style, how do they want to build a retirement strategy, but how do they also like to implement financial advice within one of these 4 categories as well. Mm-hmm. So I think this can be a really helpful tool from the perspective of an advisor giving this to individuals to then be able to go directly into a conversation to meet that person where they are in terms of how they want to source retirement income, as well as how they want to work potentially with a financial advisor.
Mm-hmm. Now, Wade, you arrived at some percentages of how the population breaks out into these 4 quadrants, didn't you?
I do think that was reported in the paper, but those are numbers I did not memorize.
Well, it was about 1/3, 2 of them, I think it was self-directed was about 20%, and there was 34% for one, 34% for another. I wrote them out, and but 2/3 of people fell into 2 categories, and I think it was only about 20% for self-directed, if I remember correctly, but that came out of your survey. Well, this will be very helpful for advisors. Okay, this is just macroeconomics is not was not really on the menu here, but since so many people worry so much, and advisors at least seem to be extremely concerned about the environment, the macroeconomic environment, and I wondered if logically you can't really expect a dramatic increase in all of them. I would think if inflation goes up, I mean, if interest rates go up, then inflation will not go up, and if the country goes into recession, then we're not going to have higher taxes probably. But what are your thoughts on navigating, applying, what you've discovered and what you write about in the book to the winds of change?
Mm-hmm. So with tax planning, it's a really important aspect, and Bill Rickenstein's been doing research in that area, I think, for at least 10 years. And so I kind of looked into some of that as well. And if you have that opportunity, the Social Security tax torpedo, especially for more mass affluent type retirees
Mm-hmm.
who may have taxable incomes in the ballpark of like 40 to 60 to $70,000,
Mm-hmm.
by doing some strategic tax planning and delaying Social Security, they may be able to dramatically extend the longevity of their portfolio just by reducing the need to pay taxes on their Social Security benefits.
Mm-hmm.
So like Roth conversions are very important, and people are concerned about taxes increasing in the future. And we're now seeing tax reform along those lines. But even without any tax reform, tax rates go up again in 2026.
Mm-hmm.
And so being able to anticipate and take advantage of lower income tax years, and it's not just marginal tax rates, but it's also the Social Security tax torpedo that will effectively increase your marginal tax rates, having to pay higher Medicare premiums based on your income starting at 63, because it's a 2-year delay until, so if you start Social Security, start Medicare at 65, your income at 63 starts to matter at that, where you may have to pay higher Medicare premiums as well. And even the idea of, we have the long-term capital gains, that income is stacked on top of your other income. And so you may be in a situation where if I would have more ordinary income, not only am I paying tax on that, but I'm also uniquely pushing more of my long-term capital gains into a higher tax rate. That will effectively increase the marginal tax rate that I'm paying. And so we think taxes will be less in retirement. But if we're not planning ahead for these types of issues, we might find that our marginal tax rate is not less in retirement. And that's where having strategic Roth conversions and so forth is part of the strategy. And we'll see how this whole tax reform plays out as well, because they're looking to put some brakes on how much strategic Roth conversions we may be able to do. But I think that's hugely important to help build a long-term sustainable retirement strategy.
Mm. And then you don't say a whole lot about inflation in the book. Do you? And do you think that inflation should not be a major compelling inflation protection? Should not be people who remember the 70s very well. Remember being burned, though. I remember the 70s as being a great time, and it was really one of the best buying opportunities that the world has ever known. That's when Warren Buffett swept together all his blue chips at rock bottom prices. But you don't, do you think it doesn't have that much effect in retirement?
No, I mean, I'm concerned about inflation. One small protection just with the retirement strategy is a lot of time people's spending doesn't keep pace with inflation in retirement. It's more like they have the go-go, slow-go, no-go years. So that could provide a relief valve. But my approach to inflation in the book is explained more in terms of, well, assume a higher inflation rate for the budget as one way to manage inflation risk. And then I go through all the different retirement risks, and inflation is there. And then think about, do I want to have additional reserve assets to manage the contingency of inflation being higher than I anticipated? And so precautionary savings then becomes the other way. I talk about managing inflation risk. In terms of like tools beyond that, of course, I'm an advocate of using TIPS and I bonds, especially right now with you can get a 0% real interest rate from I bonds, which the entire TIPS yield curve is negative, which just means on real terms, you're not going to keep up with inflation. But beyond that as well, I think like an annuity you don't need the inflation protection in the annuity, but by helping to reduce the distribution need from your remaining investments, that can help your investments to better manage inflation risk that way. And well, those would be the main things. I think having a strategy for inflation is important, but it's not so much, it's the general. Think about TIPS if you want. Stocks hopefully will provide over the long term growth to match inflation, though there's no certainty about that. But also then just precautionary savings is then going to be the main way I talk about managing inflation risk, which just means saving more than you may ultimately need to have because you are wanting to be comfortable in retirement, knowing you can manage a higher inflation rate than you may have necessarily predicted.
Well, I guess if inflation is going up, maybe if you have a house, the value of the house is also going up. So maybe then you can spend a little of what would have been legacy for your children and then let them have the house. There's
although house prices are quite volatile, especially at the individual level. Beyond the Case-Shiller price index is like it's the same thing. The S&P 500 is more diversified than one individual stock. Especially for retirees, if they're living in an older neighborhood or not having as much home upkeep, their home may not keep up with inflation as well as the overall like house price index would suggest.
Right.
So that might
I thank you for having simplified. Of course, there's a million different ways that you've simplified the overall process, but then there's plenty of decisions to work through. I think we have some questions that we have time to throw at Wade. Let's see. Oh, before we go to questions, I would like to see. I would like to just announce, because I'll forget about this if we go into questions. We have a special subscription offer for people who are not currently subscribing to Retirement Income Journal. Can use that link to go to a page to subscribe at a discounted price. It's a 20% discount for people who are attending today's webinar, and then it's just our URLs /subscribe-now/Pfau, and so that would be available for a limited time. That will be live, and then not to leave out people who have subscribed. Wade has also graciously allowed us to offer this book at the special discounted price of 15%, and that's up to a 50% discount, I think, from the retail price. So again, that's the if you want to jot down either of those, and for the book, you can just send me a email, and I will and your address, and I will ship it out to you. Okay, let's go to questions. Okay. No. Okay. First question. Can we speak to the recent movement in government to eliminate or limit backdoor Roth IRA conversions?
Yeah, I mean, I'm concerned about that with as of next year, based on what the House Ways and Means Committee report has created. There will no longer be the backdoor Roth contribution. So that's going to be, I'll miss that. I think a lot of people will. And then also limits on the ability to do Roth conversions above certain income levels. And it's still not clear because there's going to be a rule you can no longer convert, you can no longer make non-deductible contributions. So hopefully you can still convert existing non-deductible contributions. That aspect, I think, still needs to be hashed out. But yes, if the reform passes as it's currently outlined, we may see fewer opportunities, or at least more limits on the degree of Roth conversions possible, because now we'll be dealing with that upper income limit as well of the 400,000 single, 450 joint, not allowing Roth conversions above those income levels.
And the same viewer said that, does each Roth IRA have its own 5-year waiting period before gains can be withdrawn without a penalty?
No, that's just based on when you established your first Roth IRA. So then, like if I put $1,000 into a Roth IRA 20 years ago, I'm set. So you do want to get a Roth IRA established, because the 5-year rule there's 2 different 5-year rules, but this one is just based on the first Roth IRA you create. It needs to be at least 5 years since you created a Roth IRA, not the Roth IRA you're trying to use.
Yeah. Okay. Then we have sounds like a comment, or there is a question here. Will there be a replay with slides? Well, we'll have a recording, and we'll be sending out the recording to people who registered. Hope that answers the question. The next question: of the 1,500 retirement researcher community participants, what fraction of them surveyed cleanly into only one of the RISA quads? In other words, was there considerable crossover of survey participants into 2, 3, or 4 quads? I guess they're pointing out that you can't easily pigeonhole people.
Yeah, some people may be close to a dividing line, but ultimately the report shows the RISA matrix and where their dot is, so they can see if they're close to a border. But and it's a kind of a normal distribution around that. So yes, there does tend to be more people closer to the middle range than to the extremes. But we did place everyone into a quadrant, and we asked them how they felt about that, and the feedback on that was quite positive. Of the vast majority of people thought that we correctly identified their style. Yeah, I mean, they can be close, but they're going to be still on one side of the dividing line, and so that would be the style we give them.
Right. Nothing's precise in this business. The next question, I appreciate the discussion on liquidity. Can you please elaborate on liquidity in the context of retirement income, which may be different from liquidity in an asset management context?
Yeah, well, liquidity in asset management is usually just about, can you get into those assets? Like if you have a brokerage account, it's liquid in that regard. But that's because modern portfolio theory and wealth management, it's really treated as an assets only problem, that you're just trying to grow a pot of assets. There's no particular liability you're trying to fund with those assets. So within retirement income, we have to do asset liability matching. We have to fund our liabilities or expenses from our assets. And that's where that idea of true liquidity comes into play, that just because something is liquid in a traditional sense, if it's earmarked to fund a particular liability, it's not really liquid. If I spend it on, I mean, I could technically spend it on something else, but if I do so, I'll jeopardize the ability to meet whatever liability I was originally intending for that asset. So true liquidity in the retirement income context is, after having matched sufficient assets to my other liabilities, do I still have additional assets available? Only then would I say that I have true liquidity for my financial plan. So it doesn't matter whether or not the brokerage account is liquid. It matters, is this an asset that's not earmarked for some other purpose?
Yes, well, I certainly always want to have some cash on hand to take advantage of a crash, so that I can buy some bargains. Next question is, once Social Security benefits are taxed at 85%, is the tax torpedo still an issue?
No, once you've got into an income level where an additional dollar of income is not pushing another dollar of Social Security to be taxed at 85%, you've left the tax torpedo and you're no longer being impacted by it. So it really only applies. The high net worth individuals are mostly going to pay tax on 85% of Social Security, and there's no way around it. But for Americans who may have a couple $1 million even, tax planning can help manage the tax torpedo. And it may not be that they pay tax on 0% of their Social Security, but paying taxes on 30% of their Social Security is a lot better than paying taxes on 85% of Social Security. And that's where the most value would lie, more with like the mass affluent retirees.
And there's a follow-up to that. Is there a tax torpedo issue for someone or a couple who convert IRAs to Roth and have taxable income, including a Social Security benefit for the younger spouse, up to the top of the 12% marginal tax bracket? Get hit
at exactly where all that comes into play. It could be, but usually the strategic Roth conversion, part of that is when you're delaying Social Security benefits. If you're already retired, you have a window to really take advantage of strategic Roth conversions. And then once Social Security benefits start, there'll be fewer opportunities to benefit from Roth conversions. But for that, I mean, that specific scenario, I have to do a little bit of testing to see. There's no one tax torpedo. That's part of the trouble too. Depends. Every Social Security benefit has a different tax torpedo. So you can't really answer a question like that without specifying what's the Social Security benefit and then working through that to see what the tax torpedo looks like with that benefit. So there may be some benefits where it's impacting the 12% bracket more, but 22% is going to be a big one.
Conversion limitations don't kick in until 2031, right?
Under the current tax reform with the upper income limits, yes, there's going to be potentially a 10-year wait. But with the idea of a backdoor Roth conversion, that would be eliminated as of 2022 under what's currently been provided to us.
We also have a question for me. Is there a consumer rate for RIJ for DIY investors? We do have well, there's a discount offered to you through this webinar, and we do have month-to-month rates. And but we also offer a money-back guarantee. So if you don't think after 90 days that that it was worthwhile, you can certainly get a refund. But we don't have a consumer rate per se. When available, will advisors have the ability to customize the RISA questions in the tool, or say shorten the list?
Yeah, absolutely. And so let me just, if I could mention that again, if you go to risaprofile.com, it's RISA profile, all one word.com, there should be a pop-up that's on October 25th and 26th, we'll have an advisor challenge, a 2-day workshop where we'll go into full detail about how the RISA works, give you an opportunity to take it, and then talk about how you could use it within your firm. And yes, absolutely, you can customize there's a lot more aspects of the original RISA study that I didn't discuss right now, but you can fully customize what you want to ask the client as well as what you want the client or prospect to see. For example, you probably wouldn't want them to see their financial implementation matrix, but you could ask them those questions and you could have that as a resource. And yeah, you can fully customize what you're asking people, whether it's just the core RISA or some of the other modules.
So we're a little over, but I will squeeze in 2 more questions. A person asks, do you have any tax avoidance recommendations? I should say maybe tax minimization recommendations for those working past 70 and delaying Social Security until 70.
In those circumstances, it really depends on, are they, like, how high is their salary at that point? Have they cut back some? Because all the tax planning is, the reality is you have to pay tax. You just want to do it at the lowest possible rates. And so you want to look for opportunities where you can pay taxes at a lower rate. So if you're still working past 70 and you've started Social Security at 70, you might have fewer opportunities to be paying taxes at a lower rate, and therefore the Roth conversions may be less beneficial, but you'd have to look at it on a case-by-case basis. And in those circumstances too, the Medicare, the IRMA, those are, if you have $1 too much, you can suddenly be paying, with the first threshold, it's $860 more per person. So for a couple, 17, what is that? 1,720, I think, dollars more, just because you had $1 too much income. And so that kind of situation you'd want to put a lot more attention to when you're in a scenario where your income's probably high enough that you're not able to avoid the tax torpedo anymore. And also thinking ahead to heirs. Okay. And if you have an IRA that may go to adult children who are going to be in their peak earnings years and now have to take that money out in 10 years instead of using a lifetime stretch, your tax rates in retirement at that point might be lower than your heirs' tax rates will be. And so that might speak to further Roth conversions, as well as protecting a surviving spouse who then has to switch to single filer tax rates as well.
Now, Wade, on the changes for the inherited IRA, is that are deaths before 2020 grandfathered under the old rules?
Yeah. With the Secure Act, the death before December 31st, 2019 is still the old, the lifetime stretch was available and it remains. Although there is the change where if that individual, any contingent beneficiary after that will now have a 10-year window instead of being able to continue the lifetime stretch.
Okay. And we'll end on a question that we cannot answer because it would take hours. How does an investor figure out what kind of annuity to buy if he or she is seeking something more complex than a SPIA? The market is so complicated, especially in the variable rate annuities and the RILAs. Well, yes, it certainly is complicated.
I hope the RISA will help with that because, like I say, we're working with CanEx now to be able to shortlist instead of having to go through the whole universe of FIAs and RILAs and variable annuities. Based on your style, it really speaks partly to your preferences between downside protection and upside potential. Here are some annuities that can better meet that preference, and also based on your age and gender and whether it's joint or single filer, or not filer, but a single payout.
Or get yourself a copy of Annuities for Dummies by Kerry Pechter.
Yeah, Alex Margia mentioned you did a great job writing that book, or you did a great job writing about annuities from something else. And I did say, well, he is the author of Annuities for Dummies.
Well, thank you very much. Wade, it's great having you as a guest because no question stumps you. You always have a cogent question and you're consistent. You don't change your mind from year to year, which is, and so thank you very much. We're going to stop the webinar there, and thank you everybody for attending. As I said before, there will be a recording that will be sent out to everybody who's registered, and you're welcome to take advantage of the subscription offer. Okay, thanks Wade. Until next time.
Thank you. Thanks everyone.
Bye.